Today, Luke and I are going to be talking about the Secure Act. The Secure Act is a relatively new change or update related to retirement accounts, and it's going to impact some SAANYS members. We're going to do a thorough overview of the Secure Act. So hang in there as we go through this, and we're going to save questions for the end. As many of you know, Equitable and SAANYS have been partnered together for over 10 years, and Luke and I work with SAANYS members and meet with SAANYS folks on a day-to-day basis to go over benefits, financial plans, financial overview, and give people guidance and insight, and certainly happy to help with anything that you might need in your financial future. Today, Luke and I are going to get into a lot of information, and some of it is going to be related to taxes. We're not tax advisors. So if you have questions about specific taxes as it relates to your situation, please be aware you should talk to your CPA or tax preparer. But we're going to go through some examples and scenarios related to taxes today, but please note we are not tax advisors. So what we're going to talk about today is we're going to talk about who the Secure Act impacts, what the Secure Act is, when you should begin to plan for it, how do you start planning for it, and where can you go for assistance? So starting out, how many of you heard of the Secure Act 2.0? So let's just take a poll. In the range of novice to savvy, where do you stand? It gives me a gauge on where I need to be on the spectrum, or where we need to be on the spectrum of information here. Okay, that's helpful. So many people don't know what it is. That's helpful. Luke and I are going to do, like I said, a thorough deep dive. We're going to go slowly because it is going to impact a lot of SAANYS members and very potentially their spouses. So who is impacted? What the Secure Act is the Secure Act is a Biden era retirement account change. And what it did is it made updates to retirement accounts. And this is the last phase of it. There are 4 phases, and the final phase started in January of 2026. This specific phase impacts a very specific group of people. And I'm about to overview that specific group of people. And if you say, this doesn't apply to me, please note it may apply to your spouse. It may apply to you in the future because this isn't going to go away. So in the event this doesn't apply to you today, it could apply to anybody else. So that doesn't mean you shouldn't necessarily think that it only should apply to you today because it could happen to you in the near future. It applies to people who make over $150,000 a year in 2025 FICA wages based on box 3 of their W-2. W-2s are coming out mostly at the end of this week, which is why we're having the Secure Act presentation today. So if you get your W-2 and you make over $150,000 a year in 2025 FICA wages, this is going to impact you. And if you're over the age of 50, and if you contribute over $24,500 a year in 2026 to a 401k, 403b, and or 457b or deferred comp plan. So somebody needs to have all 3 of these scenarios met to be impacted by these changes. Now, this isn't just for school or non-for-profit employees. This could be a corporate employee, a municipality employee, a hospital employee. This could be anybody in the United States that meets all 3 parameters. It could be you in the future. Maybe you're 48 today, maybe you turn 49 this year, and you're going to be 50 next year in 2027. And this could apply to you at that time. Or if you get a different job, it could apply to you if you get a pay raise. So please note, though it might not apply for you to today, it could apply and impact you in the future. So with that, do any of those factors impact your spouse? If you could answer the poll for me, because that could change things a little bit with the scenario. How many people could this impact their spouse? Okay. All right. Thank you. Now let's get into the weeds of what the Secure Act is. So, as I had said, it's a 2022 law. It was a Biden era law that made sweeping changes to retirement accounts. It has to do with aspects of personal finance surrounding things like required minimum distributions, which are distributions from retirement accounts that everyone must take, mostly starting at age 73 or 75, related to 401k, 403b, and 457 plans. It has to do with catch-up contributions and Roth contributions expanded. So please note that all of these are impacted through the Secure Act and may not impact you today, but will in the future. So now let's talk about the impacts on your 403b or your 457 deferred comp plan.
So starting in 2026, to really get into the nuts and bolts of it, of how it's going to affect your 403b, your deferred comp, 401ks, and just yourself as a whole. So any amount you can contribute to a qualified retirement plan, which would be any of those accounts, 403b, 457b, or 401k, as your catch-up contributions will only be available to be contributed as Roth contributions. So first, let's explain what a catch-up contribution is. So a catch-up contribution is allowed for anyone that is over the age of 50. And essentially what the IRS does is allows you to put additional money into your 403b or other retirement accounts for you to catch up your savings for retirement. And your age determines how much extra you can actually put in addition into the accounts. So if we look at that from the numbers, and if you are over the age of 50, you can contribute an additional $8,000 to your employer-sponsored retirement plan, like a 403b, 457, or 401k. So to back up for 1 second, for anyone under the age of 50 in 2026, the maximum contribution they can put into a 403b or those other accounts is $24,500. Was $23,500 in 2025, just went up to $24,500. Most years it goes up. In addition to that, once I reach the age of 50, I can put in an additional $8,000, meaning my total maximum contribution is $32,500. However, if I'm between 60 and 63, I actually get an additional catch-up. So this is where it becomes age dependent, because if I'm between 60 and 63, I can contribute not 8,000 in addition, but 11,250, meaning that my total contribution for 2026 is $35,750. If I am past the age of 63, it just stays or goes back down to 32,500. So it's just those 3 years from 60 to 63. I get this special, let's call it a super catch-up provision. Now, what's the challenge behind the Secure Act? So previously, if you qualified for a catch-up, so you're over the age of 50, you could put those contributions into the pre-tax portion of your 403b, 457, or 401k. Now, with the Secure Act 2.0, if my FICA wages are over 150,000, my catch-up has to go in as a Roth contribution. So what does that actually mean? What does that look like from a difference? So important to understand, okay, what is the difference between pre-tax and Roth? So just a quick poll here. How familiar are you with the differences between pre-tax and Roth dollars? It's an incredibly even split. It's good. So we got a lot ranging from not very familiar to I know a lot about it. Just to overview the difference between these two things. So in my tax shelter plans, my pre-tax retirement accounts, 403bs, 457, and 401ks, when I contribute to these accounts, these pre-tax accounts, the money literally goes in pre-tax. So if you look at your paycheck, you get paid, there's your 403b contribution, then there's your federal and state income tax. So the NT, the circle, means it's not taxed. So to give an example of that, if I make $100,000 to keep numbers simple and I contribute $10,000 to a 403b on a pre-tax basis, I'm only actually taxed on $90,000 of income. That money is then invested and it grows what's called tax deferred. So basically, as the investments gain interest, you don't pay taxes on the interest. Then, when you go to take that money out in retirement, you can't, or it's then taxed at your current income rate at that point. So a lot of people will ask, how much taxes do I pay in retirement on my 403b? Kind of depends on what other income you have and what tax bracket you're in at that point. But basically, with a 403b, you void the taxes today and you pay the taxes down the road. So how does that compare to a Roth account? So in a Roth account, you put the money in and it's already been taxed. So again, if you look at your paycheck, you have your paycheck, you pay, get your gross pay, you have all your taxes come out, and then your Roth contribution comes out. So now, if I made $100,000 and I contributed $10,000 to my Roth 403b, I'm still taxed on $100,000 of income, even though I didn't use that $10,000 for whatever. Then the money is still invested and grows tax deferred. So as the investments gain interest, you don't pay tax on the interest. But now the benefit is you take that money out in retirement, it's completely tax free at that point. So regardless of what your income tax is, you're not paying taxes in retirement, but you are paying the taxes up front. Now let's take a look at just the way the tax code actually works. So here we have a breakdown of the 2025 tax brackets versus the 2026 tax brackets. And you can see we have the married filing jointly and the single brackets. Little secret, if you just take the single brackets times it by 2, that is the married filing jointly brackets. We put an outline around the 12, 22, and 24% tax brackets because that's where most folks on this call will likely fall. Really, the 22 and the 24 will probably be the most. Doesn't mean some aren't going to be in the 32 or higher, but most will probably be in that range. So the United States tax code is what's called a laddered system. So let's take the married filing jointly 22% bracket. You can see that goes from $10,000 or $100,800 to $211,400. If I make $100,801, the entirety of my income is not taxed at 22%. Only the dollars I earn over 100,800 are taxed at 22%. So if I make $100,801, that last $1 is taxed at 22%. So all things considered, we're not too concerned with making $1 over 100,800. But now what happens if we make $10,000 over 100,800? Because now we're losing 22% of that last $10,000 of earnings. So where we used to be able to put that or most of that in a 403B to catch up, now you can't do that. So now you don't have as much control over your taxes to basically lower yourself into another bracket. The other thing with this only includes the federal tax brackets. We didn't put the New York State brackets up here as well, but you do pay an additional New York State tax on top of your federal taxes as well. And that would increase the more income you have, same as federally. So what Kelly will talk through is an actual live example of what that would look like.
So let's think about this on a practical scale, okay? So if we think about this big picture, so think about it, you're a SAANYS member, maybe you're 52 years old, you're married, and now you're making the most money you've ever made in your life. Maybe your kids are grown and you don't have a lot of deductions, right? Your mortgage is largely paid off, and as your kids, you're not able to claim them on your taxes anymore, and you're at a point now where you're making the most money you've ever had in your life, and you don't have any of the tax benefits you did, and you don't have many tax opportunities to leverage anymore. Really, one of the very few tax opportunities you have is to save into your qualified retirement plan, 401k, 403b, 457. Now, for the purpose of this scenario, and this is a micro scenario, that's a macro situation. This micro scenario, we're reflecting somebody who is a single person. There's too many variables if somebody's married. And I'm going to walk through a micro example so we can look at the tax impact that the situation and the Secure Act really has on somebody. So all this being said, okay, Secure Act 2.0 and the overage now goes into Roth money. Okay, what does this really mean for my taxes when I go to file? And this is where it becomes a big deal. And at tax time, there's going to be a lot of upset people. So here's where the rubber meets the road, folks. So we've got Richard here. Richard's 55. He makes $150,000 a year. Richard is single for the purpose of this example. There's too many variables, married, filing jointly. In my example, Richard puts the maximum amount in his pre-tax 403B under the pre-Secure Acts 2.0 scenario, which max 403B contribution was $32,500 a year. Because Richard was over the age of 50, he could do the catch-up provision. So now Richard's W-2 income is $117,500 because that's $150,000 minus his 403B contribution. It's a dollar-to-dollar reduction, and that's his income on his W-2, $117,500. So he's got the maximum dollar-for-dollar taxable income reduction. Now let's look at the scenario in this change. Okay, so on the right-hand side, same gross income, $150,000. Same max 403B contribution, but now the overage of $8,000 has got to go into Roth monies because of the Secure Act. So $24,500, the maximum pre-tax goes pre-tax. That's going to reduce Richard's taxable income. Now the over 50 catch-up of $8,000 must go into Roth contributions, as Luke explained. Now the W-2 income is $125,500 because Richard only got up to $24,500 in the dollar for dollar taxable reduction, because that $8,000 is now Roth dollars. What is this going to mean for Richard tax time when he goes to file his taxes in 2026? Well, we did the math, and the long and short of it, it's going to be about $2,250 of federal income taxes. So that means when Richard goes to file his taxes, he's going to owe $2,250 more in federal taxes, all things being equal in this situation. $2,250 more in this situation when he goes to file 2026 federal income taxes in the spring of 2027 for filing for 2026. And that's just federal. We're not even talking about state. It's a lot of money. Now, you want to get into the scenario if people are married filing jointly. There's too many variables there for us to give an example. Long story short, it could be a lot of money, but every situation is different. Now, if somebody's going to have the situation, they have to plan. They have to plan now. You can't get to November and say, oh, crap, I forgot about that Secure Act thing, and now I've got Roth. It's too late in November. You only have 2 months left. This is all payroll deducted. You can't write a check to your 401k, 403b, or 457. This is all payroll deducted. So if you do planning now, early in the year, there are absolutely strategies that you can put in place to work through this. What are those strategies? Drastically vary person to person. Married, access to different retirement accounts. Some schools have both a 403b and a 457. There can be a lot of scenarios and a lot of options here that could absolutely work for people to make this work so they don't get walloped with a tax bill. But people are going to get walloped with a tax bill. You heard it here first. And we're having this conversation to be proactive in the discussion because it's going to happen. And an additional $2,250 in federal taxes is a big tax bill. And that's really under a pretty good situation. Like I said, it can get decently ugly if we're married filing jointly, but that's neither here nor there. Now, the other situation with this is it depends on where you are. Obviously, in the state of New York, that this is going to be more prevalent in some areas than others, but it's going to apply to everyone in the United States. This is not a New York State thing, as I mentioned. This is a country thing. So what's the good news? I know you were waiting for that after I just unpacked the bad news. The good news is that $8,000 and the $2,200 tax bill that you now have, well, you can take that out as tax-free money in retirement. And that is good news. You will appreciate that at some point in time. You will value that, not when you have the tax bill this year, but someday down the road, you will appreciate Roth money. It is a good thing. So there is good news in this. You do get a value. It's just down the road. So that Roth money is a good thing. And then I think I've outlined pretty clearly the bad news that many people, including SAANYS members, when they're making the most money, have the fewest tax benefits and deductions, are now going to be in a position where they now have to pay more in taxes. So, and if you think about it, it makes sense. Be the IRS. What is the IRS's goal? Well, they probably have a goal of collecting more federal taxes. That is their job. They're doing their job. What is the group of people they might want to target to collect more in federal taxes? They're very smart people, and they have very good actuaries who are determining what is a targeted group of people to focus on. They don't just make up this number, $150,000. It is not a mistake. The math is mathing on this for a certain population. So this is intentional. You can be strategic and work your way through this. You just need guidance and advice for how to do it. Honestly, in mine and Luke's world, it's not that hard to do, but you got to know what you're doing and you got to start planning today to know what you're doing. Now, food for thought, couple of things. We've got FAQs, so we're going to go through. Also, the QR code at the bottom right-hand corner is our email address. So if you want to set up a time to meet, as always, you can reach out. And of course, you can always get the email from the chat. Okay, so how can you be impacted? You need to take advantage of the catch-up provision. And if you want to, you've got the Roth part, which will potentially be a tax challenge today for a tax benefit in the future, which may result in a taxable income increase now. And you got to begin to plan early. You're getting your W-2 right now from school. You got to look at that box 3 on your W-2. So when you get your W-2, you got to look at box 3. If that number is close to 150,000, now if it's over 150,000, you are going to be impacted this year. If it's close, you might not be impacted. If it's under, you might not be impacted this year, but your time is coming. If you take a new role and that changes, you got to be aware of that too and reach out for help proactively. Okay. If you're turning 50 in the near future or your spouse is, you got to pay attention to this. 50 comes quick, unfortunately. So all these factors combined, just make sure you pay attention. It will sneak up on you. And if you're just like, I don't know, you just unpacked a lot, just reach out. We'll take a look at your situation and we'll know very quickly if this is going to impact you and how, and give you some strategies to get some assistance if you need it and guidance appropriately. So what should you do now? What are your actionable items? Make sure your plan has a Roth option in the 403B. This is a little tricky. Typically, the third-party administrator for these 403B plans is the Omni Group. The Omni Group does a really good job. Every day of my life, I check the Omni Group's website for these school districts to see if they have Roth options available. Some do and some don't. I am told that every school is coming with Roth options, but they do not all have Roth options set up today. What happens if the Roth options don't get set up into, I don't know, but I'm sure they will be, but some of these schools don't have Roth options set up yet. You should check. It's easy to do on the website or check with your payroll department. Check to see if they have Roth set up. And then just make sure that there is some type of system in place that this is good to go when this could apply to you in the fall. Meet with your financial professional. And then also when you do your taxes, meet with your tax professional and bring this up. Your tax advisor should be talking to you about this. It's very easy for them to tell if you're 50 and make over $150,000 a year and max out. That's all on your W-2. And they should be giving you guidance on this too. So there should be some guidance and insight there, but you've got to meet with someone proactively. Waiting on this will not work. Okay, so in summary, are you or your spouse coming on 50, 50, or older than 50? Check that box, yes or no. Do you or your spouse contribute the maximum amount to your employer-sponsored plan for retirement? Does box 3 of you or your spouse's W-2 say that you make more than $150,000 a year, or they do? Will this impact you or your spouse potentially in the near future? If you check these boxes, or your spouse does, and it's all three, not just one or just two, it's got to be all three for one person, then this is going to apply to you. As always, you're overwhelmed, you need help, you're confused. This is a lot to unpack. I understand that. Reach out, send us an email. I'll get back to you right away. We'll set up a time to